In economics, income distribution covers how a country's total GDP is distributed amongst its population. Economic theory and economic policy have long seen income and its distribution as a central concern. Unequal distribution of income causes economic inequality, which is a concern in almost all countries around the world. Classical economists such as Adam Smith, 1723-1790, Thomas Malthus, 1766, 1834, and David Ricardo, 1772-1823, concentrated their attention on factor income distribution, that is, the distribution of income between the primary factors of production, land, labor, and capital. Modern economists have also addressed issues of income distribution, but have focused more on the distribution of income across individuals and households. Important theoretical and policy concerns include the balance between income inequality and economic growth, and their often inverse relationship. The Lorenz curve can represent the distribution of income within a society. The Lorenz curve is closely associated with measures of income inequality, such as the Gini coefficient. The concept of inequality is distinct from that of poverty and fairness. Income inequality metrics or income distribution metrics are used by social scientists to measure the distribution of income and economic inequality among the participants in a particular economy, such as that of a specific country or of the world in general. While different theories may try to explain how income inequality comes about, income inequality metrics simply provide a system of measurement used to determine the dispersion of incomes. There exist some problems and limitations in the measurement of inequality, as there is a large gap between the national accounts, which focus on macroeconomic totals, and inequality studies, which focus on distribution. The lack of a comprehensive measure about how the pre-tax income differs from the post-tax income makes hard to assess how government redistribution affects inequality. There is not a clear view on how long-run trends in income concentration are shaped by the major changes in women's labor force participation. Causes of income inequality and of levels of inequality include labor economics, tax policies, other economic policies, labor union policies, Federal Reserve monetary policies, the market for labor, abilities of individual workers, technology and automation, globalization, gender bias, racism, and culture. The progressive income tax takes a larger percentage of high incomes and a smaller percentage of low incomes. Effectively, the poorest pay the least of their earned incomes on taxes, which allows them to keep a larger percentage of wealth. Justification can be illustrated by a simple heuristic. The same dollar amount of money, e.g., $100, has a greater economic impact on only one party, the poor. That same amount has little economic impact on a wealthy individual. So the disparity is addressed by ensuring the richest individuals are taxed a greater share of their wealth. The state then uses the tax revenue to find necessary and beneficial activities for the society at large. Every person in this system would have access to the same social benefits, but the rich pay more for it, so progressive tax significantly reduces the inequality. If a cash is given to a poor person, he or she may not make the best choice in case what to buy for this extra money. Then there is the solution in form of the food stamps, or directly the food stamps, or directly the food as an in-kind transfer to the poorest. The rent and upkeep of housing form a large portion of spending in the lower income families. Housing subsidies were designed to help the poor obtaining adequate housing. This provides actual money to the people with very low or no income and gives them an absolute freedom in decision making how to use this benefit. This works best if we assume that they are rational and make decisions in their best interest. Income mobility is another factor in the study of income inequality. It describes how people change their economic well-being. a move in the hierarchy of earning power over their lifetime. When someone improves his economic situation, this person is considered upwardly mobile. Mobility can vary between two extremes. One, rich people stay always rich and poor stay always poor. People cannot that easily change their economic status, and inequality then seems as a permanent problem. Two, individuals can easily shift their income class, AG, from middle earning class to upper class, or from lower class to middle class. Inequality is fluid and temporary, so it does not create a serious permanent problem. Mobility is measured by the association between parents and adult children's socioeconomic standing, where higher association means less mobility. Socioeconomic standing is captured by four different measures. Using Gini coefficients, several organizations, such as the United Nations, UN, and the U.S. Central Intelligence Agency, CEI, have measured income inequality by country. The Gini index is also widely used within the World Bank. It is an accurate and reliable index for measuring income distribution on a country-by-country level. The Gini index measurements go from 0 to 1 for 1 being perfect inequality and 0 being perfect equality. The World Gini Index is measured at 0.52 as of 2016. The World Inequality Lab at the Paris School of Economics published in December 2017 the World Inequality Report 2018 that provides estimates of global income and wealth inequality. Standard economic theory stipulates that inequality tends to increase over time as a country develops and to decrease as a certain average income is attained. This theory is commonly known as the Kuznets curve, after Simon Kuznets. In the United States, income has become distributed more unequally over the past 30 years, with those in the top quintile, 20%, earning more than the bottom 80% combined. 2019, the wealthiest 10% of American households control nearly 75% of household net worth. Low unemployment rate and high GDP are signs of the health of the U.S. economy. But there is almost 18% of people living below the poverty line, and the Gini coefficient is quite high. That ranks the United States ninth income inequal in the world. Inequality in the UK has been very high in the past and did not change much until the onset of industrialization. Incomes used to be remarkably concentrated pre-industrial evolution. Up to 40% of total income went into the pockets of the richest 5%. In the more recent years, income distribution is still an issue. The UK experienced a large increase in inequality during the 1980s. The incomes of the highest deciles increased while everyone else was stagnant. Uneven growth in the years leading up to 1991 meant further increases in inequality. Throughout the 1990s and 2000s, more even growth across the distribution meant little changes in inequality, with rising incomes for everybody. In sight of Brexit, there is more predicted income distribution discrepancies between wages. The United Kingdom was doing a lot to reduce one of the widest gap between rich and poor citizens. Thank you for watching. Don't forget to please like and subscribe. If you have a topic you would like to suggest, leave a comment.